Life insurance can be a great financial tool, but not everyone needs it. How do you know if it's right for you? My name is Grady Cool, CEO of Cool Wealth Management. I'm going to walk you through when life insurance makes sense and when you might not really need it, so that you can make a confident and informed decision. There are a few major considerations we need to go through. Then we can go through what type of life insurance is available, as well as whether you should get it through your employer or through an independent agent or company. Before we get into considerations, we should maybe go over what exactly even is life insurance. The basic concept is that if you were to pass away, then there would be a set amount that would be given to people you designate, usually family members. You pay a small amount each month, and then there's a rather large sum if you were to pass away. There's a lot more aspects to it, but that at least covers the basics. Let's take a look at the main considerations for when you might need life insurance. The first and most important is, do you have financial dependents? This is typically children, but it can also be a spouse that doesn't work, elderly parents, or even ill siblings. Let's take Bob, for example. Bob has a very traditional household. Bob works as a construction worker. His wife stays home to watch their 3- and 5-year-old children. They have an emergency fund of about 3 months, and Bob has a 401k through work that has about $8,000 in it. If Bob were to pass away, his family would have no income. His wife only has a high school education, so it would be really hard to make enough income to cover the expenses of her plus 2 kids. In a situation like this, a life insurance policy that pays out Bob's same income for a decade or two could be a massive help for his family. Another essential consideration is debt. If you have a lot of debt when you pass away, certain types of debt, they will sell everything you own in order to be able to cover that debt. Some debts will be forgiven when you pass away, such as federal student loans, but the rules for these things change over time and they can be state-specific, so it's always smart to check before assuming that the debt will just disappear when you pass away. The most common example of massive debt is a mortgage. Let's go back to the example with Bob. If Bob and his family had purchased their house using a mortgage, if Bob were to pass away, then his wife would be held liable for the rest of the debt. If they don't have any sort of life insurance or plan in place, then they're in a situation where Bob's wife might end up losing the house. The bank would just sell the house in order to cover the debt. While Bob's wife wouldn't be chased down to pay off tons of debt, this is still not a great situation to be in. The last big consideration is estate liquidity and tax planning. Life insurance has special rules around taxes, and it gets paid out quite quickly after you pass away. Frequently in retirement, people don't have large sums of cash just sitting around. They're usually living off of large amounts of income from things like pensions, Social Security, and their investments that are much more long-term in nature. None of these things are particularly liquid if you consider market timing of much importance. One way around this is a little bit of life insurance to help pay for things like funeral expenses. Now, what are the options available for life insurance? The easiest to understand is term life insurance. You pay a certain amount to the insurance company every month. Then, if you die within the set contract period, then they will pay the sum out to your family. This is the cheapest option available because it is temporary in nature. Meaning, if your contract expires, you need to go get a new one. And as you get older, where the probability of you passing away increases, then your premiums are going to increase over time. The next cheapest option is universal life. The premiums you pay are much more divided here. Some of the premium is meant to cover the death benefit, some of it's meant to cover the administrative costs of the insurance company, and the rest of it is put into an account that's meant to get gains from investments. These investments are typically meant to be safer than just the plain old stock market, including things like annuities or vehicles that have special rules around them like guarantees. Universal life is meant to be the most flexible option as how much you put in every month is flexible as well. While the costs of the death benefit and the administrative part can go up over time, the investment side of the account can be used to cover part of the expenses if you can't make the premiums as you grow older over time, since the investments should be growing in the account. That being said, if you do this too many times, you can run out of account value, at which point you will need to consider doing things like lowering the death benefit or making other changes to the account. A common explanation you'll hear is,
"You should use your policy while you're alive."
This is a sales pitch. So, understanding the basics can help with navigating some of the more specific parts as you get deeper into these policies. This is my personal opinion, but it's something to consider. Generally speaking, the insurance company is always going to win. They are always going to make some money off of you. So, you are going to be paying some sort of extra for the flexibility as well as the special rules that are available through some of these investment vehicles. If you're looking for a safe investment option, there are plenty of other options outside of life insurance. It can be appropriate in some situations, but make sure to just take a step back and consider the full situation before pulling the trigger. The last big option is whole life insurance. Whole life insurance is meant to be permanent in nature. Typically, with term life insurance, your policy would be over once the set period has expired. But with whole life, it's meant to be for your entire life. You still have the same death benefits, but you grow cash value using investments inside of the policy. Generally speaking, these investments are pretty similar to those available through universal life. There can be a lot of tax advantages here, but it can be fairly tricky. So, making sure you're planning this part out well can make a big difference. Because of these additional benefits, whole life tends to be the most expensive option. My rant from earlier about the insurance company always winning also still applies here. With all of that covered, which option is going to be best for you? I'm going to be fully frank with you here. I am a life insurance hater. Term life insurance is highly appropriate, especially in a lot of the situations we talked about earlier in this video. Outside of that, if there's a desired investment result, I would much rather get there with cheaper options such as cash equivalents or exchange-traded funds, otherwise known as ETFs. Insurance salesmen and insurance companies make a ton of money from selling these policies. That money has to come from somewhere. Generally, that's going to be your pockets. Assuming you're in a situation in life where life insurance is appropriate, where should you get it? Many people have it available through their employer. It generally tends to be a little bit more limited in nature, but it tends to be a little bit cheaper because of everyone pooling the costs together. If you're going outside of your employer, then you can either go directly through some companies through online portals, or you can go through an independent agent. If you're trying the direct company approach, then Google is your best friend, just typing in things like life insurance in your area. If you're doing this, always make sure to read some of the customer service reviews because there are plenty of places that just have had a lot of clients that have not had a great time. Now, if you're trying to go through an independent agent, make sure it's somebody that you trust. Ethics can be a major consideration here when selling insurance policies. Life insurance can be a great tool, but it's not your entire investment portfolio. You need to consider other things that can also help. So, if you have more considerations, definitely check out my video on real estate here. Other than that, thank you guys for watching, and I will see you in the next one.